So now we see what transactions are, and transactions are a business's economic events recorded by accountants. Economic events, that means we can write them in the form of money, and they can be external, they can be internal, they can be related to events that happened outside of the organization, or they happened within the organization. And not all the activities represent transactions, as I told you earlier. Each transaction has a dual effect, which means there will be two impacts of each transaction on accounting equation. So previously we saw that accounting equation is assets are always equal to liabilities and owner's equity. So I will write OE as owner's equity. So this is accounting equation, and every transaction will have dual impact. That means two impacts on this equation. Right, first of all we need to understand that an event is financial transaction or not. So here are some of the events and we will analyze them. For example, the first event is supplies are purchased, and as I told you that if a business purchases something or sells something, obviously that involves money, that is an economic activity, and that needs to be recorded in the books of accounts. So this should be recorded. This is a financial transaction. An employee is hired. Now, hiring an employee does not mean the employee has provided you some services. You just have signed a contract. Although this is an event, but this is not a financial event. There are no services yet provided by the employee, and you are not liable to pay anything to the employee yet. Okay, so this is not a financial event, so we will not record this as an accountant. So owners withdraws cash for personal use. Of course, as I told you, when this happens, your owner's equity decreases. So this is a financial transaction. So let's see, should we record? Yes, we should record the first one, we should not record the second one, and we should record the last one. Okay, now since we have a basic understanding of accounting equation, assets are equal to liabilities and equity, we can analyze some of the transactions and their impact on this equation. You can see that there are multiple assets mentioned here, and this is the case with the accounting information that we're gonna study in further chapters. That now we're gonna classify different kind of accounts, and the classification will be clear when we can put them under assets, liabilities, or owner's equity. So first of all, cash is an asset because cash is a resource and provide economic benefit for future. Again, account receivable is the money that you actually have to receive from your customers. You sold them products or services and they did not pay you the amount which they were liable to pay, so they will pay that in future, and that is called account receivable. Equipment again is an economic resource of the business, and if it is under the ownership of the business, this becomes the assets. Accounts payable liabilities, we have studied that in the previous lectures, and equity includes Baron's capital. So Baron is the guy who actually is investing in the business, right? So the first transaction is that the owner has invested $10,000 cash to start the repair shop. Okay, how we gonna put this into perspective of accounting equation? First of all, there is cash coming into the business. That means the cash, which is an asset, will increase. So we will show an increase of 10,000 under cash. And again, as I told you, every transaction has two impacts, two effects related to every transaction. So this is only one impact. Okay, where is the other one? Now the other one is going to be in the capital account. Okay, we're gonna see that in a second. That should be here under capital. All right, so as you can see, there is an increase in cash. This is the first one, and the second impact is there is an increase in the capital. So what we can say is that there is 10,000 positive amount, an increase in the capital of the owner, and the equivalent amount is increased in cash. So you can see that cash is on the left hand side of the equation, and the capital is on the right hand side of the equation. So the equation is balanced, both sides have 10,000, and then you can write this little marker in front of it that this 10,000 came from investment. So this is what we call transaction analysis. Okay, so this is transaction analysis. So whenever a transaction happens in the business, we're going to analyze that first of all in the accounting equation and then for the further documents. Right, second transaction, purchased equipment for $5,000 cash. Now the business has purchased equipment. That means there needs to be an increase in equipment. Alright, so you can see there is an increase in the equipment. The second effect is, since we have purchased this equipment on cash, that means we paid cash for this and the cash of the business will reduce, so you have a negative amount here, negative 5,000 in cash. Okay, there is another way which you can use to write this 5,000, that is in parentheses. So in accounting, negative amounts usually appear in parentheses. If you see those parentheses in a book, that means this is cash outflow. This is the money going out of the business. So as you can see, this is the sale of the business. The third transaction is that we paid $400 cash for May office rent. Okay, we have an office and we have to pay rent for that, and the amount of the rent is $400 and we paid that in cash. Again, cash will decrease, and since this is an expense, the expense reduces equity. Okay, note one thing, that for now we gonna incorporate expenses and revenues into the equity. Why? Because earlier we studied that there are two things that increase equity, two things that decrease equity. So we're gonna see those increases and decreasing right into the equity account here, but later on we're gonna separate them. We're gonna classify separately. Okay, so here we can see the third transaction, 400 decrease in cash and 400 decrease in equity because of the expense. Right, so the next transaction is the fourth transaction, where we received $5,100 from customers for repair service. So we provided services and we have earnings of $5,100 and we received those earnings. That means there will be an increase in the cash equivalent to $5,100, and there will also be an increase in equity. Okay, so these are the revenues. Next is the owner has withdrew, taken out $1,000 cash for personal use. Okay, so you take out the cash from the business, cash reduces, there is a reduction in cash, see, and there also a reduction in equity. Remember, expenses and drawings reduce owner's equity. Okay, number 6, paid part-time employee salaries of $2,000. You paid salaries, you paid $2,000. When you pay $2,000, cash reduces, so $2,000 reduction in cash, and again this is an expense decreases owner's equity, so this also decreases owner's equity. You have same amounts on the both side of the equations. So at any level, after any transaction, you can calculate both of the sides of this equation and you will find the same amount. Okay, let's go to the next transaction, which is incurred $250 of advertising costs on account. Now this is very important. These two words, whenever these two appear on account, that means well, what have we done? We basically have not paid money, right? We have incurred the cost, right? We have incurred the expense, but we have not paid the money on the spot. We will pay this on a later date. Okay, so we gonna just say that put this amount in our account and we will pay you after some time. So here we have not paid any cash. That means there will be no change in the cash account. But since we have to pay this, this is our obligation. That means you will see an increase in the liabilities. So there is an increase of $250 in liabilities. Again, this is an expense, so this will reduce the equity account. Number 8 transaction is we provided $750 of repair services on account. Again, on account, as we have incurred cost on account, we can also provide services on account. This time we provide the service, but we don't receive any cash, so we don't see any increase in cash, right? So what will happen? There will be an increase in account receivables. Account receivables means the money that we have to receive in future from customers. Again, so this is the revenue which increases equity, so you will see an increase in equity. Again, verifying the fact that we will have always at least two impacts of any transaction. So let's see the last transaction. We collected $120. We had to collect $750, and out of those $750 we have collected $120 cash for services previously billed. Okay, when you receive money, so you have seen a cash increase of 120 because you have received this money. Again, there is a reduction in account receivable, which is 120, so there's a minus here. So these are the two different impacts of this equation. So after these 9 equations, you can make a total of each line. You can make a total of the cash. What was the net cash? There was a 10,000 increase, 5,000 decrease, 400 decrease, 5,100 increase, 1,000 decrease, 2,000 decrease, and 120 increase. The net is 6,820. Again, account receivables on 630, and there is 5,000 in equipments, and that should be equal to 250 plus 12,200. So basically 12,450. That is the total on both sides of the equations. That means your equation is balanced. So your equation should always remain balanced after every transaction.